Okay, so I think now we've got everybody on stage. If everybody could just go around introducing themselves, if you could start with Maheen, please.
Sure, and hello everybody, and very happy to be here today. My name is Maheen Rahman, and I'm the Chief Executive at Infrazamin Pakistan. Infrazamin is a new initiative of the Private Infrastructure Development Group, and we operate with a mandate to help push financing of infrastructure projects, in particular those that are geared towards climate-friendly policies. And we try and do that by unlocking private capital in the domestic market to bring forward solutions towards closing the infrastructure gap that exists in Pakistan today. We do operate under the entire PIDGE mandate, so pushing the SDG mandate in all our projects is a fundamental part of our philosophy. And we do that under the ambit of impact investing. And this is something that's very new to Pakistan and very innovative. And with this credit guarantee features that we offer, credit enhancement facilities that we offer, we certainly do hope to move the needle, particularly in the ambit of climate finance. Thank you.
My name is Nazmira Mula. I work for 91. We're the fund manager for the Emerging Africa Infrastructure Fund, which is the debt fund that PIDGE that forms part of PIDGE. We currently, Emerging Africa currently has $1.1 billion committed to various projects across the African continent at this point in time, almost 55 projects that we're involved in, all developed by the private sector or at times partnering with some government-related entities that are run along private sector lines. So long history of supporting private infrastructure on the continent, large growing book of renewable energy in that book at this point in time. In our broader business, we have $180 billion under management, and 2/3 of that is invested in emerging markets, so both in Africa, but across Asia and Latin America as well. And what we're seeing is this growing shift to how you help countries in emerging markets transition, and how you help companies that operate in those jurisdictions transition at this point in time.
Welcome, Nazmira. Maybe we can go over to Vietnam, Mr. Hung Lee.
Hello, my name is Hung Lee. I am a CEO of Vietcombank Security, a state 100% owned by Vietcombank, a state-owned company, and it is #1 bank in Vietnam. My company is among the top security company in Vietnam, and we have successfully advised quite a large number of structured bond deal for local cooperation and connected them with the international and domestic investor. We also have a close relationship with international strategic partner like Mizuho Bank, CGIF, Granco, IFC, and other international financial group. Investors in Vietnam are well aware of climate change has worsened the bad impact to the nature for the Vietnamese. We can see the tendency of domestic investor gradually say no to financing the fossil power plant, and local companies shifting their interest into the renewable energy, rather than those can bring bad impact on the environment. It is seen that investors in Vietnam have the same reaction as though in the developed country. That is the priority of the project is environment friendly. Thank you.
Thank you, and thank you for that quick introduction to investors in Vietnam. If you can move over quickly to Chinua in Nigeria.
Hello, good morning, everyone. Thank you for having me. So I represent InfraCredit. InfraCredit was established about 4 years ago, 4.5, by the Private Infrastructure Group in collaboration with the Nigerian Sovereign Investment Authority, where established as a guarantor, local currency guarantor in Nigeria, to mobilize long-term financing from local pension funds into infrastructure, enabling institutional investors like the pension funds to diversify and allocate more local capital to finance the infrastructure deficit in Nigeria. We are also backed by KfW, Africa Finance Corporation, AFDB, Infraco Africa, Garanco, both under the Page Group. InfraCredit is helping solve a market gap in Nigeria where there's a lot of deficit in infrastructure financing. On the other hand, we have pension funds that also need to be mobilized to invest more and allocate more capital in long-term financing to finance corporate infrastructure debt. To date, InfraCredit has helped to mobilize across the energy and transportation sector close to over $100 million Naira equivalent of long-term financing. We've helped to extend the tenor for corporate debt from less than 5 years before existence to over 15 to 20 years, just very recently. I think one of the key things we bring is financial inclusion by enabling first-time borrowers to access the bond market in Nigeria, financial deepening by extending the tenor of debt for investors and broadening the investors, and financial innovation by enabling new instruments to the market. Of course, the capital market, the long-term domestic market, has a very important role to play in Nigeria's energy transition, and I look forward to talking about that in this session.
Thank you, Chinua. Now, last but certainly not least, Vivek.
Thank you very much, Janice, and thank you very much, Marco. I'm Vivek Mittal from, I run AFIDA Africa, which is Africa Infrastructure Developers Association. We are a non-profit. We have 40 members who are mostly profit-making investors, developers, financiers of all kinds of infrastructure across Africa. And our singular mission is to scale quality infrastructure across Africa. There are many routes to doing that we're looking at. There are two fundamental problems issues that I'll be discussing later today. And they are that infrastructure projects take too long to develop in Africa, and that doesn't help anybody. There are many causes for that. The other is we are in the midst of a global energy transition in view of climate change, which Africa may just miss out on if we don't act. So these are the two challenges that I'll be talking about, but there's more to come. Thank you very much.
Thank you, Vivek, and thank you everyone for joining us. I can see we've got participation from Canada, Singapore, South Africa, Sweden, Pakistan, Philippines, and Vietnam. So let me very quickly set the scene again. As Marco set out at the beginning, we know climate change is not just an environmental challenge, it's also a social economic crisis, and it's affecting millions of lives. The science is clear. The sobering, incontrovertible fact is that we need to halve our emissions by the end of this decade to keep the global temperature rises under 1.5 degrees centigrade. As a result, of course, we've seen a concert of committed and prominent people and organizations aspire to zero carbon emissions and set zero carbon targets and pressure for more disclosure. So maybe I can just hand over to Nazmeera as a global asset manager out of South Africa in an emerging market. What are you seeing in your business, both from sort of international and local investors? How is this drive to curb emissions affecting your business?
Thanks, Janice. I think for South African investors, this is something that they are paying attention to, but is not the key priority at this point in time. And I think what we're seeing from a lot of our South African investors with a heavy ESG focus is that there's probably more concern around addressing the social issues in South Africa at this point in time than the climate issues. What we're seeing from our international investors is completely the opposite. So if we look at our Northern European investors in our emerging markets, credit or debt funds, for example, there's a massive focus on how do you reduce the carbon intensity in portfolios. And that's a conversation that we've started to have with them, because we, as a business, are very committed to reducing carbon emissions in the world, to trying to mitigate climate change. However, we think this needs to be done in a manner that allows emerging markets to transition. And Well, I think sorry, Janice. The last point from me is the desire by investors to have some linear reduction in carbon in their portfolios every year can have some very horrible impacts on capital to emerging markets, and that's what we're trying to work with them to mitigate.
Indeed, Nazreen, in fact, that's what I wanted to probe, which is this whole idea of how are international investors actually trying to achieve the net zero. What are you actually seeing? What is the practical result of them trying to achieve net zero in the portfolios you manage?
So the good news is what we're seeing is for most investors, I think that there is an awareness that ultimately that they need to start, they need to have managers that assess transition plans of the companies in portfolios. However, I think what's happening is one of our very large investors said to us recently, we know that on a 3-year view, that's where we want to get to, is we want to invest in companies with great transition plans that even if they have high emissions, that we can work with them to reduce it. However, we need to see progress now, and therefore for the next 3 years, please can you decrease your carbon intensity of your portfolio by 20%? And that's not actually useful. So
Indeed,
it's about trying to show them some progress, but in a way that still is useful.
And I'm guessing that it doesn't help anyone if showing progress means just buying more technology stocks.
Exactly, and I think that's the big risk with if you look at how net zero is being implemented in a lot of Europe at the moment. It's very easy to end up with portfolios heavy in US tech and no emerging market exposure.
Indeed, and that's not what we need in emerging markets. So maybe I can move over to you, Maheen, in Pakistan. Are you seeing the same thing, particularly for local investors? I know Pakistan is one of the top 10 most vulnerable countries to climate change. And you have this very exciting mandate to mobilize pockets of institutional capital into infrastructure. What are you seeing as you talk to local investors?
Okay, so I'll separate a little bit the bank market as well as the capital market. So both have different dynamics, and they are looking at this in a very different way. So when we look at government policy, which is looking to promote renewable energy, is looking to promote electric vehicles, etc., things like that, there the appetite, at least from borrowers, is certainly there. So they do come forward with the projects, and there's a fairly long pipeline, I would say, in terms of projects that are looking for financing. But the reality is that the policy framework and the borrowers have not kept up with the bank risk appetite, for example. So there what we are saying is that while banks are appreciative of these projects, their ability to price that risk or their ability to kind of accept the fact that these are new technologies that don't previously have a track record in Pakistan, and hence the reluctance to finance those is certainly coming out in a big way. And I think that's something as Infrazamin we're looking to address. And indeed, it's no coincidence that the very first few projects that have come to us are all in the solar space, and looking at distributed solar in particular, which does have the risk of multiple off-takers, which is something that the banking market doesn't quite understand. But when we bring in guarantee structures, which is what Infrazamin is trying to do, all of a sudden the financing talks at least suddenly become a lot easier. And I think it's that catalytic impact that we're trying to have. When I shift over to the capital markets and we talk about the local bond and the local sukuk markets, for example, there I would say investors are absolutely agnostic in terms of whether they're investing in a green instrument or whether they're investing in a conventional instrument. And I think that's where we really have to work, because for capital market participation to increase and the element of private financing or local currency financing to happen here in a more sustainable fashion towards such projects, the entire ecosystem still needs to be built and developed with the right incentives offered to capital market participants to look at green financing through a different lens, as you would like, for conventional financing. So I think that bridge still needs to be done. And I think that we're trying to engage on the policy side to see how we can address that. But certainly that disconnect does exist here, and let's see how we'll be able to combat that.
Sure. And of course, there's some work we can do to try and encourage local investors to move away from this agnosticism over time. But maybe we can move over to Vietnam. Vietnam is among the most vulnerable nations to climate change impacts. The diverse geography means that it's hit by typhoons, landslides, flooding, droughts, weather events, and this can only worsen in the coming years. It's apparently the sixth country in the world most affected by climate variability. Yet it is clear that the amount of capital that we need to achieve a low carbon economy is colossal. So some of it has to come from private sources. Now, Mr. Hong Lee, perhaps a perspective from Vietcom Securities. What do you see as the challenges, the obstacles and opportunities to unlock climate finance in emerging markets?
Thank you, Jenny. For the opportunity, Vietnam have a very good potential of increase the new renewable energy and renewable project. So at the moment, total electricity produced by renewable sources is only about 13%, and the Vietnamese government intended to increase to about 44% by the year 2045. So it's a huge gap there, a lot of potential for the investor. Vietnam have great potential for the wind and solar power, thanks to large sea area and high-speed wind and long hours of sunshine across the country. Besides, by the beginning of this year, the government had announced a new policy for the private and public partnership, so they can attract the investment from the private sector, private investor into the infrastructure development. So in the near future, Vietnam is still a developing country. So a lot of project is going on, and then we do hope that in the near future, a capital flow will be strengthened and open more opportunity for the investor in developing the infrastructure in Vietnam. So, and also the long-term support of mechanism and simplification of the licensing and approval process from the government will also be created to facilitate the investor transaction attraction. However, there's still some challenge for the Vietnamese. The first is the mechanism, the policy, and the legal system is not to support the development of the green financing institution, and green bank are not being complete yet. So they got some policy, but it's not a systematic. It's like several things. It's not come together. So, and also there's no policy tool to support the bank in assessing the risk of green banking. Also, the policy to mobilize the financial resources, especially the climate finance funds, are also not clear enough. Therefore, it's lack of the instruction of domestic company in need of funding and the investor interested in climate finance to connect to each other. Another challenge is the lack of information. So about the eco-friendly project, the government, I believe, it should further draw attention from public for the green bond project. Maybe we heard a lot about the green bond project, but in fact, we could not see any actual action from the government to push it and to support it in the future. Yeah. So thank you very much.
Thank you, Mr. Hong Lee. No, that's really interesting, and I think it echoes a lot of what Maheen had set out at the beginning around the work for policy and the regulatory voids, the legal challenges, the lack of information, but more importantly, how do you price these green assets since they're such nascent products? So maybe I can move over to somebody whose work is partly advocacy, Vivek, and you can tell us a little bit more about the challenges that you're seeing in Africa as well, the obstacles, but also, I guess, the opportunities that you're seeing?
I think the obstacles are a little easier to deal with, though there are many. But I think it all crystallizes. All the obstacles crystallize for me in the long development timelines for projects. We are in the middle of our second annual survey of private sector appetite for infrastructure, and looking at the interim results over here, we've got about $50 billion worth of responses, or responses from institutions and individuals who together manage $50 billion. And it's very few, just only 60 respondents. Amongst them, there are only 9 countries that account for 75% of all infrastructure investment in Africa. There are another 6 that take up another 15%. So 90% is in 16 countries, which is actually pretty stark, because that shows us that actually all this dynamics of leave no one behind and sustainable energy for all and resilience, etc. That 2/3 of Africa is being left behind on that. The development timelines. What does that mean? Basically, if a project is taking 10 years to develop, and typically 8, 9, 10 years, and I'd love to hear feedback of shorter timelines from others. That means that basically there's no learning impact of being able to perform repeat. If you look at the big projects that have been big or small projects, if you look at Bujagali, if you look at Lake Turkana, if you look at the thermal projects, people are not doing the second, third, fourth project, which means all the learning that they've gained is lost, right? That means, what does that mean for countries? It means for countries that they cannot plan 10 years ahead, right? They'll always be in a dynamic of undersupply, oversupply, and i.e. mostly in a stress situation. They're financing projects and they take on obligations which were entered 10 years back. They don't get the price discovery. Tariffs, they're complaining about tariffs, but that's why tariffs are high. Project costs are high. So there are many ills that flow from this, and this is a big area. Our respondents to our survey, and with your permission, I'll post the link for people to take that survey. There's a good group of people here. They talk about what do we need, what's working, and actually, Janice, for the last 10 years, I've been a big fan of what the PIDG group does in both risk mitigation and early stage development. PIDG group is doing many of these things, but we need to scale that up. So that is early stage institutional support, frameworks, transparency, and of course, Infraco Africa, who's not on the call, they do a lot of that work. Risk mitigation, innovative risk mitigation. So the guarantee work that you do is very, very important, and we need to scale that up. The aggregation of impacts of some of what Chinua is doing with infra credits and what 91 are doing with EAIF are very, very important. Revenue certainty comes up as a big ask of our within that risk mitigation side. Stepping back from that, there are 2 other points. One is what I would call a master plan for the economy. Planning for the economy is woefully inadequate in most of African countries. Countries the size of Kenya, Uganda, Ethiopia typically use, if you look outside Africa, countries of the similar size of GDP and population, they use about 3 to 4 times the energy that these countries are planning. Kenya, I've been working for the last 6 months very closely with the Kenyan government. Kenya is projecting that in the next 20 years, they will have a level of energy which other countries their size of economy have now. Yeah. So in 20 years, Kenya might be the size of Vietnam, and Vietnam actually uses about nearly 20 times the energy that Kenya uses. Yeah. So planning is, and the last thing we'll come to in a little bit is sustainability 2.0, focusing on doing good versus just doing no harm. We focus a lot in our assessments and projects on doing no harm and remediating that doing no harm, but we don't capture the doing good aspect. What are the benefits of these investments? So sorry, hopefully some of that made sense.
No, it's okay, Vivek. Always interesting, particularly the factoids around kind of where the investment is going to, just 16 countries. And you always remind us about the market failures that need to be addressed. And indeed, we've got a number of catalyzers with us on our panel. So perhaps I can just start with Chinua in terms of what are the instruments that can help these projects become bankable. I mean, Vivek's talked about the issue around timeline. He's talked about the issue around planning from a government level. What do you do as InfraCredit to try and accelerate the number of projects that come to market? Maybe you could give us some examples.
Thank you, Jenny. So, so InfraCredit, essentially we provide guarantees to enable companies implementing infrastructure projects to access long-term financing from the debt capital market, essentially getting the pension funds to hold these long-term assets that match very favorably with their portfolio, given the demographics and the long-term nature of their assets under management. And so we've successfully been able to get power companies, transportation companies, and very recently a special economic zone to extend the tenor of the kind of financing they get, which otherwise was shorter term, higher interest rate from the banks, to fixed, lower rated debt with tenors of up to 20 years very recently. Now, these are all unprecedented, at least within the Nigerian context, tenors of financing for infrastructure. And when we look at the portfolio of the pension, for example, I mean, they're investing less than 2% of maybe up to 35% that can go into corporate infrastructure debt. And so there's need for more supply of these quality assets. And obviously, as an intermediary, we work with a presumption that there are good quality deals that could come to operating infrastructure projects that ultimately access debt capital. But then we realized, obviously, we need to approach the market with a value chain, sort of mindset, looking at the life cycle and understanding how best we collaborate with other actors across that life cycle to help to originate, develop, and essentially produce the kind of infrastructure projects that are climate resilient and also that are sustainable for long-term capital from the pension funds. And so whilst, within all of these contexts, obviously, or within all of these is a context, i.e. in Nigeria today, we have up to 80 million people living below the poverty line. We have an unemployment rate of up to 30% plus. And we've also got, the highest number of people without energy access in the world today, about 85 million. And so you have this social challenge that you're also dealing with across, the macroeconomic constraints with COVID having had a significant impact in the economy. And therefore, I think, the lens through which we look at, traditional financing mechanisms have to evolve. Bankability now is a question of, your financial sustainability in terms of, is it financial feasible or is it economically viable? And what kind of, instruments that could help play that viability gap or blended finance role in unlocking more assets that can access long-term finance in a sustainable way. And this is where, for us, we clearly see the role, at least some of the examples and the stories that we see from Peach and others DFIs have shown in other markets. But we think that this could be strengthened, and we think more mobilization or coordination amongst the donors and the risk, capital can play a much more transformational role if it's structured with a mission to catalyze, institutions that are essentially set up to mobilize private sector capital. Because what is very clear is that it has to be, the government budgetary deficit is increasingly getting constrained, and it's very clear that, the government needs private actors to do this. But even the private are also constrained by some of the challenges you have with, just the process of unlocking these assets, those ones that sit within the public sector, and then just some of the challenges with doing business. But we think that there is a role that these higher risk kind of capital that is already established to bear this risk can be allocated in a more efficient way to catalyze and create more leverage impact, working with intermediaries. So private intermediaries that are able to help to play that role of originating, structuring ultimately, because it's really around organizing the underlying asset class and structuring them. And then, capital allocation in terms of, the blending, the risk, the first loss capital, the tranches that can bear that risk, and ultimately now crowding the pension funds. I think there's significant impact we can have in being able to organize. I think the challenge is really the organization part of this capital to play this role in helping drive being able to drive more efficiency along that line, but importantly, being able to help accelerate economic growth by being able to get more jobs created by getting projects off the ground and to financial close, and ultimately to sustainable finance, which essentially is better than just giving off one pool of grant, why don't you link it to a capital market instrument that could exist for 20 years, for 15 years, and you have other actors in that instrument that are incentivized to ensure it's sustainable. So it's a risk-sharing mechanism. It is a sustainable way. We look forward to these sort of instruments gaining more scale in countries like Nigeria. Otherwise, we know that it's very difficult with the high interest rate. Inflation is around 17% today. Access to infrastructure is a challenge. And just using traditional mechanisms to finance an asset in local currency, of course, because we also recognize that, we can talk a lot about these things, but we know fundamentally that local currency finance is critical for sustainability. So when we begin to sort of dimension and focus where capital should flow into risk capital, I think we begin to solve some of the problems. And we've attempted to do a bit of that at InfraCredit, at least with some of the track record we've demonstrated in the potential of what the local capital market can do in helping to create that level of transparency and capital formation for infrastructure projects as was never seen before, from 10 years to 15 years to 20 years. And this is all working with the local pension funds in Nigeria. So you can imagine what more can happen where we now create a more efficient sort of collaboration that can now blend and unlock. So address that bankability challenge. We're always going to keep having it with, really because of the economic challenge. So it's about cost of capital, the cost of infrastructure, access to infrastructure, because whatever cost you pay, it's going to be cost reflective on the tariff. And with the level of affordability that we see, we need to look at how best to address that with creative instruments that don't distort the market, but actually help accelerate sustainable finance. And blending does that in a very, very efficient way, especially when the right mechanisms are put in place. And we've seen this obviously through some of the things Garanco Pitch is doing. And we want to see more scaling and more sort of strategic sort of allocation of this type of capital. And we think that Nigeria does have a huge potential of resources that can help with this energy transition. I mean, we've got hydro potential in Nigeria. We also do have solar potential in Nigeria. The challenge, obviously, is the financing mechanism that can help a sustainable transition. Whilst we also look at how we manage our existing gas in terms of having to manage, energy security and also energy, transition in the country. So these are some of the policy constraints that I see, but also the opportunity that sits with where we see opportunity for growth and also opportunity for capital to work in private-public capital work, join forces in helping unlock more projects, and importantly, create the governance ability that is much needed. And this is where technical assistance also plays a very critical role. So we've seen a bit of that with the projects we've done, and the examples of deals that have benefited from some of these kind of structures. I mean, one or two we're working on at the moment, but we look forward to a much more, scalable approach to address this challenge. Otherwise, we really will keep talking about the transition without in a meaningful way being able to address these gaps. Thank you.
Thanks, Chinua, and thanks for those very important points. I'd forgotten, obviously, to mention the pandemic and what's that has done to public balance sheets, which has only heightened the issue around trying to get private sector capital into climate finance. Just in terms of catalyzers, I mean, I wanted to bring Maheen into the conversation because I know you mentioned at the very beginning, you've got a pipeline of distributed energy projects, and that's quite impressive, I think, given you just started in June. So, Chinua touched on it a little bit around the strategic use of development finance, but I just wanted to check if you have anything to add to that conversation.
Yeah, sure. So Pakistan is a fairly unique market in the sense that there is a tremendous amount of liquidity, whether that exists in the capital markets or in provident pension funds or even in the banking sector. The issue really here is that with all that liquidity available, there's very little appetite for risk. But the good news is that when we see, instruments come to market that address that in whatever shape or form, the market does react very positively. And I think the best way I can sort of add on from Chinua's discussion here is that Garanco which is another pitch company, which has been operating in this market for the last 7-8 years. Every project that Garanco has come and worked with in terms of the credit enhancement side no longer actually needs any intervention to find financing again. So clearly the impact is there and the market is responsive to it. Now, when it comes to Infrazamin, and we carry on from the tailwind that Garanco is leaving us, the shift is remarkably towards this sectoral shift. So whereas perhaps digital infrastructure was not so well understood by the financing market 5 years ago, now it's very understood. But on the other side, solar, in particularly distributed solar, is not understood at all. And I think here we play a very significant role in bridging the gap or bridging I would say the risk mitigation, particularly in the terms of addressing multiple off-takers as opposed to just having a single off-taker, which the market is used to. So I think on that front, at least we are well positioned to force that change in. I think just beyond even looking at that, there are some sectors here which are being very heavily pushed by the government. And those sectors are somewhere, again, where risk appetite is virtually nil. So when we pick up housing, for example, affordable housing or low-income housing, the developer finance market is not well understood. And I think that's something that certainly we can enable the risk transfer and risk mitigation measures on as well. When we talk about electric vehicles, Pakistan has one of the largest car markets and growing car markets in the region. However, EVs are less than 1% of cars that you actually see. And with the policy shift to move towards a heavy usage on EV vehicles in the next 20, 30 years, this is an area which is very interesting because what you will find in the EV space is that they have a better chance of raising capital from international sources or international investors than even within the local market. And I think that's certainly a gap or a risk that we can address. And by focusing on the infrastructure available within EVs, whether it's charging stations or whether it's the way the financing is built in. So I think, there are interesting new, I would say, frontiers for Infrazamin to look at. And we're seeing a very positive response towards borrowers. And I think if we can shift the way the banks or the capital markets view these new technologies, then I think we'll open the doors in the future, as Garanco has done in the past, for these sectors to have access to that financing too. I think though still there are significant challenges that will exist in the Pakistan framework, in particularly creating that ecosystem or that understanding of impact investment. And I touched upon it earlier, but if we are going to have meaningful capital market engagement, then I think the incentives for investors, whether they are pension funds or whether they are mutual funds, which is a very vibrant mutual fund market here, then we are going to have to push incentives to just address the risk reward framework. At the moment, there's no premium on green instruments. That policy advocacy of that framework certainly needs to be created. Otherwise, you will just be comparing a conventional bond to a green bond, which is not exactly the same thing. So I think plenty of advocacy still to be done from our platform, but I think the initial sort of market assessment that we can make is fairly positive and receptive. And I think it's up to us to demonstrate that proof of concept now.
Thanks, Mahin, and it's clearly work to be done. Now, I'm told that there are quite a number of questions in the chat, and we're running out of time. So I'm going to hand over now to Marco to handle the next part of the session. Marco?
Sure. Thanks, Janice, and fascinating conversation, and a lot of requests for examples. So I'm gonna ask the various speakers to think about examples to highlight about the things they've said. We've heard about blended finance and long term. How long does it take to get projects off the ground? And if I'm thinking of two projects we're involved in, and how we're trying to replicate those, one on the side of in the water sector, the Kigali Water opened the taps this year. We're trying to do the next one. It's been a while that we've been trying to do the next one, but it talks to the point of long term. How long does it take to develop projects, as well as the need for viability gap funding. If I'm thinking of the time that is getting to get the first independent power producer in Chad off the ground, which is also very close, which we are involved in, that's a similar story. But there's one point I wanted to pick up before going to a few of the questions that I've seen in the chat, and please keep them coming. But one point I wanted to pick up with Vivek. Chinua mentioned before the pandemics, and Vivek, you mentioned the co-benefits, right? The benefits of we look on do no harm, but we forget a bit about the positive impact. I mean, we know that we're lagging behind on the SDGs. We know that you've got less, you've got 120 million people pushed into poverty by the pandemic. Do we need a better market signal for infrastructure that contributes to the Sustainable Development Goals? Do we need kind of market rating for that incentivize investors who want to put their capital to purpose? What is your view from your conversations with the membership?
We absolutely do, is a short answer, Marco. And here's why. There's a main question as to example of what's working. A lot is working. The PIDGE portfolio of instruments is working. You add to that TCX, you add to that MEGA, Africa Trade Insurance, all the infra funds. That's all working. It doesn't land though. It doesn't land because countries have limited resources to take on dollarized funding. Now InfraCredits is working on local currency funding, and sounds like the Pakistan initiative is doing the same thing. However, we don't have a language or metrics to talk about what are the positives of these infrastructure projects. We do a great job, and for the last 25 years, we've been doing a great job in the developing world of figuring out the harms and the negatives and the do no good aspects of implementing projects and mitigating them, reporting on them, and managing them. We don't do. There's absolutely, and yesterday, it's a global problem. It's not just for developing countries or for Africa. If we could have a language, metrics, what is the benefit economically, socially, or in terms of natural capital of, let's say, a parent getting home early from office because of a new bridge or a new road, or the economy working very well after hours if there's regular reliable electricity. What are the benefits of that? Then it can feed into economic planning in a way that allows for allocation of scarce capital, scarce balance sheet risk. If you look at the country's ability to pay for these things as a scarce resource on their balance sheet, then these metrics certainly have a way. And we are making that a cornerstone of our work in terms of figuring out under a theme of sustainability 2.0, what are the positives that we can create metrics around and methodologies around to help focus the mind on which infrastructure projects are worth pursuing and which are not.
Thanks, Vivek, and maybe just bringing in Nazmira as well as an asset manager on this topic. Is the SDG the best possible framework to signal that? And could we imagine a rating that effectively raised the contribution to the SDG? Because if you're doing the same project with the same grade standards, it's going to be more difficult if you do that in a low-income market. It's going to cost more, and it's going to make more of an impact. But that is not priced, and it's not valued. So could the SDG provide that framework?
Marco, I think the SDG is a useful framework to use, not because it necessarily addresses all the concerns that our projects need to address or the complexity, but because it's a language that is increasingly well understood. And when we get clients, whether they're in South Africa or whether they're in Germany, wanting to see SDG mapping of portfolios. So it's becoming this language that's understood. And I think that's what is helpful in terms of using that. But I think ultimately, if we want to get more of these projects done, we are going to also have to use the SDG framework to convince the providers of more grant funding to help out as well. Because there's no point in doing projects if they're not affordable at the local level in countries. And for example, Emerging Africa is looking at a battery storage project at the moment, which is going to need a fair bit of grant funding if it's going to be viable, because we've seen that in the developed world as well. So I think it's a useful framework to use both for more commercial investors, but also for your more donor or grant funding as well.
Thanks, Nasmira, and just to plug there that this is a topic which we'll continue to explore in the run up to COP in terms of providing incentives. But looking at the Q&A session, there's a few coming, and please put your questions in the Q&A rather than in the chat. It just makes it easier for speakers to see that. Two questions. One is specifically to Mahim, and is about the sectors in Pakistan. And about hydro and water-based investments given the water scarcity. So maybe Mahim, if you want to think about that and how do you see that development and what's the current debate in Pakistan. But then before that, there are a lot of questions just asking about how do we scale things that work. So I wonder if I can quickly go back to the panel about that, and can I ask to be quick in your answers, like do one or two things to scale things up.
Should I go? Well, I'd say aggregation strategies and aggregation across countries. There are platforms. They're a fantastic example. Arise in transportation. Arise is a great. Arise IPP is a great example of a integration platform. So aggregation, and I also would add local content. So people, goods, and capital. These three things, or these are four ideas. You asked for one. I'll let the others go.
Thank you. And maybe if I can bring in the others, and again from I can see Nasmira moving and asking, like, do you want to contribute on this topic?
I think in better information sharing. There are so many initiatives from the various institutions globally to try and mitigate risks in projects, and I think the availability in terms of what is available to do what is actually quite poor. I mean, I saw a list recently of it was 170 different initiatives that could mitigate projects for the climate change mitigation projects across the emerging world. And some of them were regional specific, but I think most people don't know what's out there, and they exist in a little box. So information sharing.
Thank you. And there's also a question about digital infrastructure there, and how do we see that at Pitch? And I can say that that's certainly something which we're looking at with a lot of interest, and in terms of connectivity in rural areas in particular, and in terms of then the links to, for example, connecting schools, connecting clinics, and combining power with digital infrastructure in rural areas, and what that can mean. And there are a couple of quite exciting examples that are coming up both in Indonesia as well as in Africa. So that's certainly something which will continue to work and has gained prominence with the pandemic. If I can go to Maheen and the question on Pakistan and water scarcity and hydro, that was quite specific. But your thoughts on that?
Sure. I mean, I can address both on the digital side as well as the water side. So water in Pakistan has historically been mispriced, and it is a water inefficient country, I would say. I think the focus of the government has been towards building upstream dams, which does cause, social issues as well in terms of displacement. So in terms of a coherent water policy, I think that's certainly the need of the hour in terms of how we will preserve as well as develop our own water resources, because given that it's an agricultural country, this is going to be a crucial point for policy making in the future. I think with regards to digital, Marco, and I can lift from that as well. So in Pakistan, digital infrastructure, particularly on the telecom side, is well established. But in terms of upstream, downstream, we look at fiberization, for example, of those telecom towers or transition to 5G. Those are actually areas that we are seeing opening up here in particular in making those projects more bankable. And I think when we consider the kind of risk that's associated with fiber players, etc., those are very necessary to improving digital access. And that's an area which banks have historically shied away from. But we are again seeing that through credit guarantee frameworks, etc., we can open the door to lending. And I think that's one of the projects that we have also recently begun to look at. So I think certainly the opportunities are there in certain spaces and segments. And those opportunities actually have the ability to impact in a big way, particularly in a place like Pakistan, where you have significant rural population. So certainly, I think that's on our agenda as well.
Thank you. And I'm just aware of time, and I'm aware that this is a conversation that we'll have to continue. There are two questions which I'd like to hand over to Janice for the final parting shots. One is about the blockage to replicability. Again, how do you replicate things? Is it size, geography? And there's a question. The answer from Vivek was aggregation, but I think there's a related question to this, which is what can we expect from COP and climate finance? And Janice, I wonder if that's a good way to end the discussion on.
I think that's an excellent way to end the session. And if I can just ask each of the speakers for today to just give me one sentence, one sentence of what do you want to tell COP26? You've got this exciting meeting at, I think on the 31st of October is when it starts. What's the message you want to send to COP? So let's start from the reverse, from how we introduced ourselves. So I'll start with Vivek, and then we can go in reverse. Vivek, over to you. What's your one parting shot?
To foster repeatable, transparent, and replicable projects.
Okay, thank you. Chinua?
I think in Nigeria, and I believe in most African countries, we all want to transition, but in an equitable way. And also building local capacity is critical. And also looking at recognizing and helping to integrate across that. Thank you.
Okay, thanks. Not quite one sentence, but thank you very much. Mr. Hung Lee, what's your message for COP?
Yes, yeah. I would like to send a message to COP26. Just make it incentive, yes, and then the market will do all the thing, yes.
Yep, create the right incentives. Thank you very much. I think then we go to Nazmira. Nazmira, can you hear us? Your parting shot for COP?
I think it was frozen on my side. My one message would be for the big pools of savings, stop measuring carbon intensity and seeing that as an end goal.
But
focus on transition, stop measuring carbon intensity.
Great, thanks. And last but definitely not least, Maheen.
I think just a summary, there are significant funds that have been committed by developed nations towards emerging markets to address climate adaptation mitigation strategies. A coherent and predictable stream of how those funds will be utilized and in what form, without necessarily adding to the debt burden of emerging markets. I think that would go a long way towards helping climate finance in emerging countries.
Thank you all. You've been an excellent panel. We've come up to the top of the hour, so I think we have to end now. I just wanted to thank also all our participants from Zimbabwe, Canada, Nairobi, Nigeria. Thank you so much for attending. I just want to take the opportunity to wish everybody a good day and a good week ahead. Thank you very much.
Thank you all.
Thank you all.
Thank you. Thank you.
Thank you.
Thank you. Thank you, everyone.
Thank you very much, and all the very best. Stay safe.